Well, hello and welcome to Trading Blows from TraderX. Another busy show this week. Plenty for us and the panel to get our teeth into. We'll have a look at the catalysts that may spark a bit of a resurgence in volatility across the board, why markets are continuing to fight the Fed when it comes to the idea of rate cuts in the back end of the year, and also where the balance of risks appears to lie for the global economy over the coming months. Without further ado, let's get into the show. So let's meet our panelists, as always, going head-to-head over 4 rounds. They'll score points for a great response, and they'll have the threat of points being chalked off looming over them if a dispute is raised over their answer. Of course, the better the response, the more points that they will score. We're starting the recording slightly late today, and there's been a few emails going around about impertinence and Ryan potentially needing to be docked points, but given that it is me that is the cause of us starting late, I think I'll have to dock points from myself once again. Joining me on the panel this week, Ryan Paisey, the founder of PIQ Suite, Richard Matthews, a senior broker at deliverable FX firm Pardus FX, and last but by no means least, Ioan Smith, who's been in the markets for a couple of decades now at various tier 1 banks and running his own research firm as well. And he's also got a variation of Ryan in his background as well. With all of that said and done, let's get on with the first round of the show. So I want to talk about volatility, first of all, or the lack of it, really. It seems that markets have settled into a little bit of a rhythm. If you look across the board, the VIX is below 20. Volatility, implied vol and realized vol in most major asset classes is at its lowest level in a few months. In the FX market, implied vol is pretty much at the bottom end of the 12-month ranges, and also in the equity market as well. So we're going to go in order of sartorial elegance to start the show. So Dick, we'll come to you first. What do you think are the catalysts that we should really be looking out for that might liven markets up a little bit and mean that we're not struggling to stay awake when we're sat at our desks during the day?
Mikey, good morning. I know that everyone thinks debt ceiling is a red herring. I'm not totally convinced.
That might be a point off in the first 5 seconds.
Right, thank you. Straight in. I think there is a danger that they miscalculate the timing on their negotiations, and they absolutely screw it up, and they don't agree a new target or new total, which would cause absolute chaos in the markets. I think there's too much brinkmanship going on there. Just a real off the wall bet on that. Apart from that, I still think there's problems in the banking sector, both in the States and over in Europe. Notice that Jamie from JPM said yesterday that he was full up on small banks. I'm not sure that's entirely true, whether he's broking. Commercial real estate, I think, could be the catalyst there. Certainly in the Wall Street Journal yesterday, saying that offices were being dumped very, very quickly. World War III, my favourite subject, as you all know. I think that we're upping the ante with Russia too much. Interesting that South Africa is now supplying arms to Russia, whether that's true or not, but there's certainly the threat there.
How are they finding the electricity to make the arms? That's the question I've got.
Well, I don't know how they do that in the electricity, but China, Taiwan, I think, still lingering on in the background. But on the financial side of it, possibly you might see something out from Japan to shock the markets. Whether they want to, Ioan wants to stamp his new name on a new policy.
Right, can I just interrupt? So, have you got access to my notes? Because I've mentioned in my notes, I've got commercial real estate, I've got Japan, I've got South Africa.
What else have you got there?
Whoa.
You know what the biggest revelation there is? That Ryan makes notes, I think.
I need to.
I couldn't read them. Before, not wanting to steal too much of Ryan's thunder, I'll finish off very quickly with a couple of other points. I just think that the UK is starting to look a bit shaky. Seems like there's an internal war in the Conservative Party as much as there is in the Labour Party. And finally, actually, if you want volatility, go and trade the Turkish lira, because that looks like it's going to be fun for a couple of weeks.
If you can find somewhere to trade it, that is, because liquidity there is. You can for now.
How wide are your spreads?
Well, think about a double-decker bus, and then maybe like 5 of them. And that's kind of close. Ryan, let's go to you before anyone else steals off your comprehensive notes. What are your thoughts on the lack of any movement we're seeing?
To be honest, you might as well just give Dickie a couple more points that you were going to give me, because he's done everything. All seriousness, I think all hell summer markets. It's been a while since we've had some nice, what I say nice, it's been a while since we've had traditional summer markets. And you know what they say about summer markets, the best thing you can do is nothing, sit on your hands. So plenty of sport on this summer, get that inside you. In terms of the debt ceiling though, firstly, piss off. There's something that I think it's worth talking about, and Dickie said about the timing of the brinkmanship and stuff. You can only really go on what's happened previously and how we kind of believe politics works. And I think the fact that the leaders, so McCarthy and Biden, have already had direct talks, or were being told that they're directly communicating. I think that's a positive sign, because normally it's the serfs that get all the details out the way, and then they come in with just like the big ticket items. So I think that's if you were looking for a positive, that would be it. Also, as we all know, I don't believe for a second that we get a default or any of that bollocks. There's also chatter started yesterday about Biden cutting short his planned foreign jaunt. He's going to be missing out Australia because he's already going to be seeing the Australian leader as part of the G7, I believe it is. As Dickie said, so Dickie gets a point for this, I guess. Keep an eye on Japan. Inflation is definitely it's still, although from a very low level, it's still got it's maintaining a decent momentum. Also, wages in Japan rising at faster pace than expected as well. And on top of that, yesterday they announced that they're going to increase the domestic power prices up to, I think it's between, depending on the situation, between, I think I've read 17 and 42%, or something like that. There could be some more inflation to come on there. Again, what Dickie said, I think if you wanted to keep an eye on one kind of smaller kind of aspect of, especially the US economy, it would definitely be commercial real estate. We're hearing a lot of pain in that area. Also, real estate in general, you've only got to look at Blackstone shuttering or sticking the gate up with people trying to redeem their funds out of UK real estate funds. But to be honest, I think one of the reasons Vol's staying low is simply because no one has any conviction. It's not, it's not because, I think it's very easy to fall into the Vol is low because the markets are only trending up. Vol can be low just because markets are going nowhere. And I think that's what it is. There's so much cash on the side at the moment. No one has any conviction, especially, no one's going to have a conviction trade ahead of the debt ceiling thing. So until that's done, I think Vol stays low.
No, I think you're right there. Ioan, would you be on board with that? Do you think some of the ranges that we see, you're kind of looking at 4,000 to 4,200 in the S&P, the dollar's in a range, treasuries, the 10 years stuck at 3.5%, the 2 years stuck at 4%. Do you think we're just going to kind of bob along here for the time being, or are you playing things slightly differently from where you are?
Well, for a start, I'm aggrieved at being lost when it comes to sartorial elegance.
Oh, yeah.
Well, God, to make up for it, you can have a point as consolation. There you go. And our Sri Lankan friend will now moan about my story.
Yes.
Going back to your point, especially, I know you tend to focus on the VIX and how the market's pretty much sanguine and everything. It was just as a point of interest. There was a spike in the VIX August 60 calls yesterday. Of course, we don't know whether this is like an outright punt or a hedge, but it's just something to keep an eye on. I'm not sure we'll be range bound too much. I know we've got to talk about the debt ceiling. CDS prices, another one again. 1 year CDS prices record high. 5 year CDS levels back to 2008. I'm not too bothered about CDSs myself. I tend to think that the treasury market will be more the reflection of where people are when it comes to tail risk or default risk, especially with one month T-bill yields above 3 months. So that's tend to about, where you'd look. But in terms of like the debt ceiling, I think once that's out the way, we're going to the market will move on to the next thing. But ultimately, going back to the debt ceiling, I'm with Ryan. I think eventually it'll go through. But an interesting point, I raised it in last week's show with the Treasury General account, where there's basically the government's checking account where they run their day-to-day business. And yesterday there was a significant amount got sucked out of it. It was like 53 billion. So that's taken it down to 87 billion. And the Treasury has said that the level is 25 billion where they'd start to get really uncomfortable. But there are like different vehicles that they can do to get there up. But I thought that they would get to at least the second week of June before they would have to, start to bring things in where they wouldn't pay congressmen and women or pensions and things like that. But ultimately, once an agreement is reached with this, they'll be able to issue debt to pay bills, and then that'll include back payments. But the only issue then is what might spark some vol, like you said, is once the debt ceiling's out the way, they've got to then rebuild that Treasury General account back up to 600 billion from the 87 billion it is now. And then there's going to be all that liquidity is going to be sucked out of the market. So I think that's something that we should be more focused on. And then after that, it'll be recession, because I think, like the market only tends to focus on one thing at a time, and that's where we are.
Go on, Ryan. Oh, you were just agreeing. I thought you wanted to jump in.
No, I was just agreeing. I thought that was a really good point. I love the point about, it's not just about solving the problem. It's also about filling the coffers after the problem's solved, which I hadn't thought about. So, yeah.
Yeah, and I think the other thing to bear in mind on that front is, and I know our friend Arno has raised this a few times, is what are the implications of the compromise or the deal that they come to resolve the debt ceiling? We all know it's going to get resolved, but what degree of spending cuts, what degree of restraint do the GOP extract from the Biden administration? And coming back to your point around recession, Ioan, how does that impact or negatively impact the growth outlook in the back end of the year? And that could put Dick's idea that the Fed are going to hike again at risk. And we'll get into that now in the second round of the show. So I fear I may have slightly stolen Mr. Matthews' thunder there, but we'll come to him in a second. Ryan, we'll kick off with you this round. I want to dig into what's going on in terms of Fed pricing. We see this real disparity coming through between what the Fed are saying, both in the dot plot. Yes, we all know the usual caveats around that, but also in the speeches that we hear. No one is really giving any indication that they're looking at loosening policy during this year. But then the market continues to price. I think before I jumped on to record this morning, it was around 65 basis points worth of cuts between July and the back end of this year. Two parts to this question, really. One is, why do you think markets are doing this? And the second is, how does this end up resolving itself? Do the Fed fold and do what the market is trying to sort of bully them towards, or have investors got this one totally and utterly wrong?
Well, I wish you wouldn't have come to me on this question, but there we go. So at the moment, what have we got? So the market's currently saying that next meeting is 8% unchanged. Personally, I don't know why anyone is expecting Fed speak to include stuff like the word cut, or why they would even hinted it, because we haven't even paused yet. So, Fed speakers aren't going to go from hiking to cutting in their language that quickly, because there's too many variables on the plate, on the table. They're very conscious that no matter what they say, they will get berated for it. So, even non-voters, which we know, can basically have a little bit more free will on kind of what they say to the market. And like I've always said, make sure you know who's voting and who isn't when you start seeing Fed speak on the wires. There's no reason why the market is wrong to suggest that we cut at the end of the year, simply because it's not been spoken about by the Fed yet. those two things can, Fed speakers not mentioning cuts and the market pricing in cuts later in the year can both exist in the same world. I think it's a bit not naive, but I think it's a bit misplaced for some people, especially experienced traders, to suggest that, oh, we've not heard one mention of the word cut, yet markets are pricing in a cut at the end of the year. The markets look beyond what Fed speak is looking to, if that makes any sense. Kind of moving on from directly just talking about the Fed speak, I think it's quite interesting to note that US dollar is knocking on like the 103 handle on the index, and JP Morgan noted, I believe it was last night or yesterday during the day, that bear cases for US dollars are becoming increasingly tenuous. And if you're looking towards the market for a guide of where they believe the Fed is going to end up, or more importantly, where the actions of the Fed are going to end up, you've got bonds gearing for a recession, technically based on pricing, and stocks saying soft landing or no landing at all. To me, I would be, if you had to believe one market, I'd believe bonds. However, I'm not a big fan of the idea that recession instantly means that you're in the shit, because at the end of the day, the definition of recession is looking backwards. So you're already in the shit by the time it turns out you're in a recession, right? So the whole recession element is always backward looking, which I'm not a fan of. In terms of equities, I know that I say equities maybe are mispriced because they're anticipating a soft landing or no landing at all. At the same time, I remain bullish equities. The reason for that being that, it feels like everyone on the street and all the big shops are saying they're now underweight equities, or at least they're increasingly nervy about their overweight positions, which to me says that the fear of missing out, the old FOMO, from an on an institutional scale, is geared to the upside. Because if your S&P starts, which is the benchmark for many of these funds, and most portfolios are benchmarked to the SP, right? So if that starts breaking higher, you have no choice but to commit that cash you have on the sidelines to get involved. And I think that's that's where we could see a disconnect, a big disconnect between what we're seeing in bond markets and what we're seeing in stocks, even though there is already a disconnect in kind of what you would traditionally say they're pricing in. I think the main thing that one of the main things we need to be watching for the Fed and how they will react, it's obviously, inflation numbers obviously are up there. And increasingly, just keep an eye on the credit tightening, because it seems to be every kind of survey we get recently, it's like the creepy uncle in the room. Pardon me, if you know what I mean.
Where's this going?
Sorry. Well, no, but you know what I mean? It's like, so it's getting tighter. Sorry, that is a really bad language to you. Credit tightening is getting more severe, it seems, with every survey. It's not just in the US, it seems to be branching out across the G4 as well. Lending standards are just, they're getting harder. But on the flip side of that, we're also seeing less demand for credit anyway. So, there's a lot at play. If you wanted a TLDR, it would be the fact that we're not talking about cuts doesn't mean that we're not going to get cuts, because any Fed official would be bonkers to start predicting a cut when we haven't even had proper pause yet. So, there you go.
Well, we have had plenty of bonkers Fed officials and Fed speak in the past, so I certainly wouldn't rule that one out. Ioan, what are your thoughts? I mean, Ryan mentioned that debate that seems to have gone on the back burner a little bit around soft landing, hard landing, no landing at all. Do we take off again? All that nonsense. Where do you come down on that? What side of the fence do you come down on there? And this pricing of cuts, do you think it's all going to end up getting priced out at some point?
Well, I don't know. I mean, we're always going to come back to the inflation outlook, right? I think eventually, well, it's already started to come off the boil a bit in the US. So I think, all the rate hikes have been priced in. The market, as we mentioned previously, started to think about, other things. I mean, because all of us can only be obsessed with one thing at a time, really. So, I mean, the general trade,
with one,
apart from Ryan, yeah. But I mean, the general train of thought is that basically secular inflation will it'll settle at this higher level. So the market will start to forget about inflation in that, and then eventually there'll be the cyclical outlook we'll start to focus on that little bit more. So, as I said, the market will probably start thinking about a recession a little bit more. I mean, going back to what Ryan said, that will then be more constructive environment for bonds. Going back to where we are pricing in rate hike or rate cut expectations. Sorry, I mean, the downward slope that we're seeing, in the back end of pricing is basically between two mutually exclusive, options. Either inflation is much stickier than everybody thought, or it's going to roll over as much as everybody expects today. I think the neutral rate is about 2.5%, which is the midpoint of the distribution of the Fed funds futures path. So, I mean, that will be probably around this time next year. But, I mean, I'm not convinced that the Fed can really engineer like disinflation without having any impact on the economy. I mean, especially if you look at the extent of what they've already tightened. And we're already starting from a high level of indebtedness as it is. I mean, the New York Fed data came out yesterday, and consumer debt hit a new record of $17 trillion. I mean, since 2009, that's gone up $3 trillion, or like 20%. So, I mean, all of this is globally coordinated as well. So it's not just a US centric thing. So, I mean, if you magnify that impact, then we've got headwinds to growth. So going back to, that environment for bonds, I think, looking at the Bank of America fund manager survey, I mean, the allocation of bonds was a 14-year low. And again, if we look at that and we start thinking in a recession, then we're going to have to price in a 20 to 30% earnings decline that you would normally get in a recession. So that would get you to about 14 times on the S&P. So 14 times on the S&P equates to, below 3,000. Now, I'm not advocating that. I'm not saying that's what it is, but I mean, that's what we're coming out of a funny money bubble, right? So
easy for you to say.
I know, it really is. I mean, for me personally, if you're going to take a position, I do it through options, probably maybe deep out of the money puts on the S&P or something, just to have a trade on. But I'm not particularly interested in taking anything big over the summer.
Yeah, and I think that comes back to the point Ryan was making earlier around this general lack of conviction that we see across the board. And, I'm feeling it, you're feeling it, we're all feeling it. Everyone, it seems, has very, very little conviction behind what's going to happen next. And as a result, you see vol come down, position sizes reduce, et cetera, et cetera. One person who, when he was last on the show, did have quite a lot of conviction behind something was Mr. Matthews, because I think he confidently sat there and said the Fed will hike again in September and rates will go to 6%. Did you say that, Dick?
I did indeed. And you've always got to have conviction as a broker. If you haven't got conviction, you'll never do a trade. So,
very true. Very true.
I think it's going to be interesting, actually, because there's two things I grew up learning. I know I'm going to be ageist, and when I was on the floor, blah, blah,
You're in the floor.
On the floor. Don't fight the Fed and don't fight the market. So at the moment, you've got the choice of, one or the other. And I'm not convinced, actually, that the market's right. But having said that, we've seen central banks roll over in the past. Soros took on the Bank of England in 92, beat the Bank of England, although some would say that they're hardly a central bank anymore. Even then, they weren't the most brilliant. So there is a danger that the Fed is wrong. However, I think they're right. I think they're going to stick where they are. I think inflation's going to be sticky. We're coming out, as I've said before, of a period that we've never seen before. We've come out of a pandemic into a war. I think the last time this happened, actually, we came out of a war into a pandemic. It was in 1918, 1919. Before I was in the market.
What was it like?
Thank you. And so I think we're in a whole new world. We're in a whole new world of employment, the way that we work. Some of us work at home, some of the weeks hybrid working. I think absolutely dislocates all of these numbers. And also, as Ioan said, that we're coming out of a period of funny money. Historically, we haven't had interest rates that low for so long. I can't remember anything like that. And I think that people have just got to get used to higher interest rates. And the market is absolutely dying to see the Fed pivot and for interest rates to drop. And I think a lot of that's built in to the pricing already. Hats off to Helen Thomas from Blonde Money, who coined a new phrase. It's not now higher for longer, it's high for long. I think we're in a new period of higher interest rates, and we're going to stick. And we're not actually going to drop much from where we are. So I think inflation is going to be pretty sticky. So that's really my point. I still think that you will actually see the Fed hike again. I don't think inflation's beaten, although there are some signs of recession coming. Money supply, which we touched upon last week, is looking very, very sad, I think. And I think that's something which people are starting to watch more and more, and they should do, because it shows a contraction. And again, hats off to Helen Thomas, who I just read a report from this morning. She's saying, watch out for some of the reports coming out, earnings reports. You've got Target and Walmart, I think, this week, and then a couple of home improvement ones next week. We should get a good feeling whether the economy is slowing down a bit. I think it's starting to, but I still don't see the Fed cutting. So I actually think that the market's coming out. I think the market's wrong. And I think you could at some point see a good old dump when the market suddenly realizes it. Whether it's the Fed comes out and does something and surprises the market, couldn't bet against it. Who needs dot plots? We never used to have dot plots. You just used your own brain to work out what was going on. And I think the markets had too much guidance, and maybe the central banks will start to switch away from doing that so much now. So no way we see a cut this year. I still think we'll see more hikes. And I will have lunch on that with anyone who cares on this panel, not with anyone who's watching. I will have lunch on that with anyone on this panel. Hands are going up. God, it's going to cost.
I was going to say, you've got us three all happy to take that bet. And I think Kyriakos, who's turned his camera off, has probably got his hand in the air as well, fancying a free lunch as well. Sorry?
At McDonald's.
Yeah. Just on Dickie's point about home improvement retailers and stuff, we had Home Depot, as I should say, report yesterday, which was below expectations, and also a little bit of guidance cut as well, which wasn't obviously great news. Also, just again to go on from what Dickie said, rightfully, was the fact that people forget that low interest rates were a result of us being in the shit, right? Interest rates should not be 0%. Interest rates should have some interest on them. That's the whole point of them. So I think, there's far too many people in the markets these days, and so many, investors and whatever, got too used to too low interest rates. That is, that's an anomaly. We shouldn't be relying on that for future growth. Let's not forget 20 years ago or whatever, interest rates up 5%, 6%, 7% more, and we were still growing. Markets were still going, stocks were still going up, the economy was still growing. It's not necessarily a bad thing. Anyway,
no, again, but we'll touch back. We go back to that again when we were talking about the velocity, right? It's the sheer speed that they've done this. So they haven't given anybody the opportunity to make that adjustment, and we're still coming from again that such a significant period of debt accumulation that. And again, if you've got you're taking your mortgage out and you've gone from sub 2 to sub 4, so I can remember my dad was there back in 1978, where he told me was basically the day that he signed that mortgage, interest rates went up to about 18% and basically wiped out his entire wage packet over the month. So it's that velocity that we need to be aware of. I'm not arguing that the fact that interest rates normalized should be almost where they are now. It's you've managed people's expectations, you've taken them down that far, you've pushed them into a period of indebtedness, and then you're basically wiping them out. That's I think what that we should be focused on, rather than where interest rates are themselves.
Yeah, my point is that people have got so used to interest rates being at zero, and traders have got used to interest rates being at zero, and they think that's the normal. And I don't think they're adjusting to the new normal, which are interest rates at 4% and 5%. So I think there's a danger there that people say, we're going to cut, we're going to go back down. Well, you're not. I think there's a danger there that people actually really believe that that's going to happen. That's why they're constantly looking for a pivot. And that's, where I came from. You had normalized interest rates.
Well, it's like saying that, central banks should hike when you can, cut when you must. And that's kind of where
give yourself that room to accommodate and ease when, the proverbial does hit the fan.
You need to kind of refill the ammo belt.
Yeah, exactly that. Well, with that said and done, let's get into the second half of the show. It's slightly annoying that the viewers can't see the little jig that Ryan does every time we have that music playing between the rounds. It's like a leprechaun doing a dance. There we go. That's what he was doing. In any case, let's have a look at the UK. Obviously, we had the Bank of England last week raising rates by 25 basis points, as pretty much everyone had expected. So bank rate is at 4.5% now, which is the highest since 2008. We then had the employment data a little bit earlier this week, which was a mixed bag, shall we say. And then we've got a bumper week next week with the latest PMIs. We've got a whole host of inflation readings, retail sales, public sector borrowing. Pretty much any UK data that you can imagine is going to drop on us over the next sort of 7 to 10 days. Ioan, I want to start with you. We haven't started around with you just yet. What do you think markets are going to make of everything we get over the coming weeks and that we've had recently? And where does the balance of risks lie here for sort of UK PLC? For want of a better word.
Before we start on the UK, do you want to check Dick's blood pressure?
Yeah.
He is going slightly red in the face.
Yeah, I did.
I was going to say, just like it's getting hot in there. I'm actually a little bit more constructive on the UK at the moment, to be honest with you. I mean, obviously the economic data we've got about 2 or 3 more data points before the next meeting again, I think. But the City Economic Surprise Index is at 2-year highs. Now we know it's obviously a mean reverting series. As growth and inflation estimates are constantly revised as the numbers come up. And it's going to be a little bit more difficult for the UK to beat that on the upside at the moment. But then again, that just provides you with a decent trading environment, right? Especially for scalpers. The interesting thing is from a macro point of view, especially a top-down approach to stock picking or whatever. Then UK earnings forecasts still negative for the year ahead, whereas the US is up around 8%. Now, I think that's going to come down. I think the UK will have to be repriced in some shape or form. I think looking at the FTSE 100 and the 250, I mean, they're both, quite cheap. Their PE ratios have halved. So, I mean, I think it's trading at something like 10 times forward earnings now. So, I mean, that's something that we should probably, keep an eye on. We're all tremendously focused on, house prices and, how they're going to come down. Even Ryan's looking at buying in Wembley.
For his sins.
Cup winners dream. But, I think the housing market is well underpinned from a structural point of view. There's not really a lot of new mortgage debt, especially mortgage approvals are not at a level that they're going to keep house prices constant. Then the percentage of people that live in their house with a mortgage is as low as it's ever been. So I think a bit positive, a lot more positive about the UK, and this is even considering how badly run the country is, by basically the incompetence of our political class. So I think the banks are well capitalized. So I do think we'll probably see some sort of secular performance compared to maybe Europe and the US.
Well, there we go. It's nice to have a little bit of optimism about the UK. We'll carry that on with
optimism about the UK.
I was going to say we'll go to the world's biggest sterling bull in a second, but let's check on Dick and his blood pressure first. How are you reading what's going on with the UK at the moment? Your thoughts on the BOE last week and also the pound, because we've seen cable come probably about 2 big figures off the highs now. Do you think that downtrend has some legs?
I'm telling you, just take a pill. Just calm down a bit. Right, so let's start with the Bank of England last week. Voted
brace yourselves.
Brace yourselves, yeah. A vote of 7-2 with 2 idiots voting for no change. It's just extraordinary, isn't it? I was looking at some figures yesterday, and I will say that I don't shop at Asda or Morrison's, but did you know that Lancashire Farm Natural Bio Yogurt has gone from £1.18 to £2.18 in the last year?
We live very different lives.
We do. 4 pound onions at Morrison's has gone from 65 pence to 124. That's a 90.8% rise in the last year. And Frankfurters, which I'm sure Ryan eats out on every night, is like 93%. How is that possible? How do they justify this? Food price inflation, good news, dropped yesterday to 17.1% from 17.2%.
Look at the champagne.
It's extraordinary, isn't it? And what are they doing? They ask the farmers to come in, and and they get Jeremy Clarkson scoring cheap points off Sunak, trying to get the supermarkets to control themselves. And then there's a cheap joke somewhere about Sunak then going to Iceland, didn't realise they were a supermarket. There's certainly some greedflation there, but all joking aside, there's still some serious inflation. Wages are still rising nigh on at 7% in the private sector, a little bit less elsewhere. We've got plenty of strikes going on in the background. I still think the inflation is inherent there, and interest rates are much, much too low. But the Bank of England just seem absolutely petrified of doing anything about it. So from my point of view, that's the negative side of it. Now, whether the increase in the tax burden, which is the highest now since 1945, which is 10 years before I was born, I will say, and way before I was in the market, could well dampen inflation a little bit. So I think there's, a little bit of control of inflation there. Money supply again is dropping over here. And I agree with you. The political incompetence on all sides of the house is just extraordinary. I don't think there's a single brain cell amongst all of them. And I think it's, you listen to Starmer, you listen to Sunak, and they're just repeating each other. And it's he said this, she said that. There's nothing really constructive coming out, which to me is really, really sad. So I think there's time for a revamp of the Houses of Parliament. There's time for a revamp of the MPC. Interesting that the Sun agreed with me, thinks that monkeys could run the Bank of England better, which I don't write for the Sun, and I don't often read it. Someone pointed that out.
You're revealing all sorts about yourself. Aren't you? Dropping at Asda, reading the Sun, this illusion that you've built up.
On the plus side of the UK, I think that it's interesting that they think they're close to doing a trade deal with the Swiss, which I think is actually quite important. But growth is pretty shocking. Inflation would be better next week because I think there's a technical adjustment because of the energy price cap comes out of it next week, so it should drop down to around about 8%. But really, I can't see anything to get excited about. I think sterling's had its day in the sun and it's starting to slip. I think you could see a couple of cents off there. So I'd be a short of sterling, and certainly I'd be a short of sterling against the euro because I think, unbelievably, the ECB is actually being more proactive and positive in their outlook, or positive in what they're going to do than the Bank of England. Rant over.
Well, let's go to someone who I would bet my last pound is not short of sterling, Ryan Paisey.
Well,
you'll probably agree with me and start quoting what I've said at school.
I do want to point out that since episode 1 of Trading Blows, I've been bullish sterling, and it's gone up since episode 1 of Trading Blows. And I would like to point out that since episode 1 of Trading Blows, Dickie, my good friend Dickie, has been bearish sterling, and it's gone up since. I'm just going to float that one out there.
Okay.
But yeah, no, in terms of, I'm still bullish cable. Bullish sterling, should I say? Not so sure about being bullish it versus the dollar, although, I think maybe the dollar could be petering out a little bit. I know we're having a bit more of a leg higher into a new range, but we'll see what happens. Anyway, getting back to the UK. I think the economy has definitely outperformed what many have expected it to do, mainly because everyone was so pessimistic. So the bar was extremely low, but that's the only way we can judge better or worse than expected, right? You need to know what the expected was. There's been a lot said recently about payroll data. We had the first fall in total payrolls in the most recent data since Feb 2021. But take a step back, zoom out. I'm always a massive fan of zooming out on every chart or whatever you're looking at. And unemployment rate is still only 3.9%, which is amazing. So, and also we know as a fact for basically most of the developed world, employment data, the methodology, if I said that right, it's kind of a bit outdated compared to how the world now works, with so many people starting up their own businesses, working from home, and all people having multiple jobs working from home. So maybe this tiny rise up in official unemployment rates just simply because it's not picking up those people slipping through the cracks. I'm still bullish UK. I don't, as Ioan said, I think we've been mispriced to the downside for so long that still has to be unwound, which obviously will be another boost. As for the Bank of England, I believe, and Dickie better kind of put something in his ears at this point. I believe they should pause. I don't see the need to hike in June. Inflation, as the inflation's coming off the boil. Hopefully, it seems to be peaking at least. So if it was me, I would be calling for a pause. However, they will probably hike 25. This is the way. I see nothing that stand out concerning about UK PLC or anything. Although don't get me wrong, I agree with what my dear friends Ioan and Dick said about how the country's run has been a bit shambolic. But then again, zoom out, look at France, look at the US. We're not having a debt ceiling crisis like the US. We're not having. I know we're having some strikes, but we're not having anywhere near the strikes that the French are having. So this kind of the grass isn't always greener, and overall, compared to other comparable nations, we're not doing too badly.
No,
just
indeed.
a point there. So we've lost 600,000 days for strikes. So if you add that output back in, growth probably much better than it has been. And the other thing that what was interesting, like what Dick said about a trade deal with the Swiss, which is incredibly positive. Apparently, Boris Johnson is in South Korea and Truss is in Thailand as well. So I mean, there seems to be things going on in the background.
It's all coming up for the books.
But that's the thing. At least the wheels are turning in that regard, away from especially this stupid soap opera that we get in the Houses of Parliament every day.
Yeah.
Can I just coming in on the number of days lost in the last quarter? In the year I started work, I was going to actually quote this number. I think it's 556,000 days that we've lost this year, or something like that. The year I started work, there were 23.9 million days lost. It puts it a little bit into perspective. That actually is not quite as bad as we think.
That was because they were all over fighting in the Somme, right? Or
it was a general strike. It was a general strike.
Oh, dear.
What could possibly go wrong with Boris Johnson out in the Far East with Liz Truss? One tends to think.
Yeah,
exactly. Before we do imagine that, let's get on to the last round of the show with everyone neck and neck. That's a shame. We didn't get a dance that time.
Right, on purpose.
I was looking forward to it. He's got embarrassed. We're going to start with you, Ryan, actually. I mean, you self-branded yourself the ex-commodities expert earlier on when we were having a chat. So let's go to you first. Commodities isn't something we talk about particularly often on the show. It's something that everyone should have on the radar, but unless you're properly involved in the market, you're unlikely to be or to have a significant exposure to it. But I think if you look at the trend over the last kind of 6 to 8, maybe even 10 weeks with certain commodities, you look at crude oil prices have been rolling over, copper similar, iron ore as well. What I want to get into is, do you think this is sending any sort of message about those recessionary and growth fears that we were talking about earlier in the show? And do you think this is something that traders should be a little bit more aware of and attuned to?
Firstly, I would like to add the caveat that my days of throwing around considerable size in energy markets is way behind me. So I'm not even then, I don't think I was an expert. I was definitely just a very large punter. But yes, in terms of commodity price action, to be brutally honest, I think it's very easy to overthink this. I think we did see some extreme prices in many commodities, and so there's a lot of mean reversion out there. There's a lot of, like, in terms of mean reversion in terms of price, but more importantly, mean reversion in terms of supply and demand kind of stuff. Supply rocketed when demand was falling off, and obviously the lag effect. Also, it's a massive area to follow is the China reopening. Basically, you can drill back on most stories to that kind of that narrative. Like we had Nomura come out this morning, cutting Chinese GDP to 5.5 from 5.9. Although GDP numbers, we know Chinese data is made up anyway, right? But in terms of the more high frequency data that we see in terms of like traffic movements or stuff like this, also looking at export data. So export data from Germany, export data from Singapore that we've had recently, they have been significantly below estimates. And China is a significant export market for Germany and likewise Singapore. So if they're not buying stuff, there's a reason for that, regardless of what the data said. What I will say though, is that, and again, this is punting, so definitely don't do this, but I'd be inclined to look for the bottom of these markets, especially in the crude, mainly not because I see a sizable shift in the actual physical landscape, but more the fact that I believe we're getting, especially for crude, like I said, I think OPEC are going to start getting a little bit touchy at this point. What we got, so when I left the screens earlier on, it's like WTI was $70, Brent was about 74.50. Still very much range bound, but the obviously lower end of range. And there's a lot to be said for playing ranges if there's no inputs. Something to bear in mind, again, sticking with crude, obviously, because that's which I know a little bit more about than the rest. We're coming into driving season soon in the US. And for those that don't know, driving season is traditionally between Memorial Day and Labor Day. So this year it's May 29th, September 4th. The idea behind that is seasonally more people are driving in that period. Therefore, gasoline demand is up, which means crude demand is up. But what we've seen last year and the year before, in ignoring COVID, obviously, because no one was driving at all, but because of the impact from work from home, less people driving, the people relying on the seasonal factors, which includes the utility companies and like the physical players, there was a huge drop in what you would associate with that driving season demand. So in my eyes, if you got stung last year because of that, perhaps those seasonal players aren't going to be as likely to kind of be scooping a physical product ahead of driving season. So that could weigh on the bid coming in, which you would usually associate it. But in terms of breaking it down, without trying to get too technical, because if I do get technical, I'll be wrong. The demand, in my opinion, the demand is there, but there's just too much supply. And so the only way you can get around this, I think it might have been JP Morgan, the last couple of days said they expect, production to outpace, demand by about 30% this year. So we're already a bit oversupplied. We could see more oversupply based on current trends. So I believe it's about when are OPEC gonna maybe even unexpectedly announce a cut. If it's not going to be an if, it's going to be a when. So if I was going to be playing commodities, I would be looking to build a nice position, not over leveraged at all, because you might have to wear it a little bit offside or average at least. I'd be looking to build a long position or have at least long exposure to crude markets, because I do think we're not far away from OPEC having to do something.
And just on that point, of course, if OPEC were to do something, it probably would be a surprise and it probably would come over the weekend. So that's great if you're long, but if you're short,
you couldn't pay me to be
of that risk.
You couldn't pay me to be like an open position short at the moment. Like intraday, fine, but I would never be short overnight. But then I've never had, that's been a rule of thumb for like 20 years, never short overnight crude.
Yeah. Ioan, what are your thoughts on what's going on in the commodity space? I mean, Ryan touched on the China reopening. We had that activity data earlier on in the week. Obviously, take a pinch or maybe even a bucket of salt with it, but it didn't look overly pretty, did it?
No, I mean, it's conflicting what the true impact of, or the true macro impact is in China. I mean, it could be an upside risk. We don't know. I mean, if it opens up, then the supply chain stalls should reduce as it opens up. Or as Ryan pointed to, it's a supply issue now. I mean, I did read somewhere that China ramping up coal mining to about 4 billion tons a year. I'll have to try and find the link for that. But so the first thing I did, I went to look at the coal price, which I haven't really done for a long time. But I was shocked that for this year, it's gone from about $80 a ton to $400 a ton. So obviously, China is reaping the benefit of that. They haven't been using the LNG, but Europe has been picking up the slack on that point. If we go back to the fund managers survey again, obviously the commodities allocation was quite interesting again there. So that was at a 3-year low. But again, with all these rolling over, if the economy rolls over and there's a recession, then we have to say there's going to be a lower demand. I thought, it's interesting that, every time crude goes above $100 a barrel, a recession tends to happen soon after. I mean, happened in 1975, 99, 2000, and 2010. So I mean, it does.
Remembers them all.
Sorry,
and Dick remembers them all.
Probably does, yeah. But I mean, it's all self-correcting, right? I mean, everything gets more expensive and people have to pull back. But then again, I mean, going back to that point about, China, its reopening period, then they'd hope would be driven by consumption against, the commodity, the commodity story then. But it's all uneven. Nobody knows how, as Ryan said, right, Chinese economic numbers are made up. I mean, I've read Myth-Busting China's Numbers book, and it's shocking how bad these numbers are, how they're made up. But again, if we're looking at a consumption-led recovery in China, that's going to be lagged. And the other thing that you need to consider with China is actually they have a significant savings rate. It's really high. In the US, the savings rate is actually less than 3%. In China, it's between 40 and 50%. So when you've got, such a significant savings rate, it is a drag in basic economic terms, because a higher savings rate compared to an investment rate, you're going to have that drag. I mean, for me personally, I generally tend not to get too involved with China. I mean, of course, I'll look at the headlines, but I prefer to be looking at India, where you'd get more or less the same, demographic, advantages, but without all the communist issues behind it.
No, exactly that. Mr. Matthews, we will leave you to have the last word on the show.
Well, I know about as much about commodities as I do about being pleasant about Tottenham Hotspur. I do know that commodities do point or can point to recessions. And interestingly, lumber is trading at its lowest level for donkey's years at the moment, which is not a good time for the housing market in the States. So that's one thing I did pick up. Going back on you, and oil certainly wasn't $100 in 1975. I think it went from $3 to $12 a barrel. I think that was it was either the first or the second great oil shock. But I guess quadrupling the price was enough of a hit in the first place.
It comes back to, sorry to jump in, it comes back to that point we were making earlier about rates, I guess. It's the velocity of the move rather than the absolute level, isn't it? Yeah.
I mean, I'm going to be boring. I remember clearly queuing to fill my little Mini up with petrol. I was working for a company called RP Martin at the time. They actually bought a petrol station, so you got the petrol supplies in it. And it was a huge shock. It's the first, 75 might be the second oil shock. but it was one of the first. My God, OPEC's got some power here. I think OPEC. I agree with Ryan that OPEC will come in again and they will squeeze the market. The US is starting. I think Hochstein said yesterday they're going to start buying oil back now to top up the SPR.
Yeah.
So that is another positive. Away from that, I just think China. I agree with everyone that you can't trust a word of data that comes out from there. I think that it's all how they want to present it to the world, how they want to present it to their population. So I think that's I'm very, very wary of that. Although I did read that Michael Burry, he wrote The Big Short, is investing heavily into China, if you believe Bloomberg. So really, I got very, very little to add to what everyone else has said. I'd just be very, very wary of some of the signals coming out from the soft market like lumber, as I said. And really, in the end, I think I'd just look to buy orange juice to top up vodkas if we do get World War III. It might be the only way out.
Well, there we go. Sound advice indeed. Let's have a look at the final scores. Well, there we go. The final scores on the doors. Another wooden spoon for Mr. Matthews. He's got a whole kitchen full at this point. And Ryan, despite your sartorial inelegance, congratulations. You have somehow pulled a victory out of the bag.
Thank you.
And made the outfit look even worse. In any case, congratulations to Ryan for winning. Ryan Paisey from PIQ Suite also joining us. Richard Matthews from Pardus FX and Ioan Smith as well. Thank you to the gents for joining us. Thank you for watching. If you've enjoyed the show, leave a like on the video, drop a comment as well. Let us know how you're trading the markets, and we'll be back again this time next week. Thanks as always, and goodbye for now.